Hi there, Brian here. Welcome back to the Cashflow Desk. Today, we're diving into AI-driven budgeting. If you've ever felt like your budget is outdated the moment you finish building it, or if you're tired of spreadsheets that can't keep up with how fast your business moves, this video is for you. We're going to walk through how to set up a budgeting process that actually learns from your data and adapts in real time. So what makes AI budgeting different from the traditional approach? Traditional budgeting is mostly backward-looking. You take last year's numbers, add some growth assumptions, and hope for the best. The problem is that by the time you spot a variance, you're already weeks or months behind. AI-driven budgeting flips that around. Instead of just using historical data as a starting point, it continuously analyzes spending patterns, identifies trends, and adjusts forecasts based on what's actually happening right now. Think of it this way. Instead of driving by looking in the rearview mirror, you get a GPS that recalculates the route as conditions change. The foundation of any AI budgeting process is clean, connected data. You need your accounting system, whether that's QuickBooks or NetSuite, feeding historical transaction data into the AI engine. This gives the system a baseline understanding of your spending patterns, seasonality, and growth trends. But here's the critical piece. AI-driven budgets need real-time spend data to stay accurate. Historical data tells you where you've been, but real-time data tells you where you're going. This is where platforms like Ramp become essential. When your corporate cards and expense management are integrated directly into the budgeting system, the AI can spot variances as they happen, not weeks later when the books close. Once your data foundation is solid, you can set up the AI forecasting engine. Tools like OpenAI can handle the forecasting logic and scenario generation. The system analyzes your historical patterns, things like seasonal fluctuations, growth rates, and spending correlations, then builds predictive models around them. For example, an e-commerce business might see that marketing spend typically increases 40% in October, followed by a 25% jump in fulfillment costs in November. The AI picks up on these patterns and factors them into future forecasts automatically. The key is training the system with enough clean data to recognize legitimate patterns versus one-off events. Generally, you want at least 12-18 months of transaction history to get reliable predictions. Traditional budgets use static categories that don't adapt. AI budgeting lets you build dynamic categories that adjust based on business drivers. Instead of budgeting a fixed amount for marketing, you might set it as a percentage of projected revenue, with the AI adjusting spend recommendations as revenue forecasts change. Or take software subscriptions. Rather than budgeting a flat monthly amount, the AI can factor in team growth projections and automatically adjust SaaS spending as headcount increases. The system can also identify spending correlations you might miss. Maybe your shipping costs always spike 2 weeks after a marketing campaign. The AI catches these relationships and builds them into future forecasts. This is where AI budgeting really shines: real-time monitoring and automatic adjustments. Instead of waiting for month-end reports, the system tracks actual spend against projections daily. When variances hit certain thresholds, it can automatically adjust future forecasts or trigger alerts for budget owners. For example, if Q1 marketing spend is tracking 15% higher than planned, but it's driving proportionally higher revenue, the AI might recommend increasing the marketing budget for Q2 rather than cutting back. With real-time spend data flowing in, whether that's from Ramp or direct bank feeds, the system can also spot unusual patterns immediately. A sudden spike in office expenses or an unexpected software renewal can trigger alerts before they blow up your budget. One of the biggest advantages of AI budgeting is scenario planning. The system can run multiple forecasts simultaneously, best case, worst case, and most likely scenarios, all based on different assumptions about revenue growth, market conditions, or operational changes. This is especially valuable for businesses with variable revenue streams. A services company might model scenarios for 80%, 100%, and 120% of projected client retention. The AI shows how each scenario impacts cash flow and spending across every budget category. You can also stress test specific variables. What happens if your top customer churns? What if a key supplier raises prices by 20%? The AI runs these scenarios instantly. A few practical tips for implementation. Start small. Pick one department or budget category to pilot the system before rolling it out company-wide. Make sure your chart of accounts is clean and consistent. AI is only as good as the data it's trained on, and messy categorization will lead to unreliable forecasts. And don't abandon human oversight. AI is great at pattern recognition and number crunching, but it can't account for strategic decisions or market shifts that aren't reflected in historical data yet. So there you have it, AI-driven budgeting that actually adapts to your business. The key is connecting clean historical data with real-time spending information, then letting the AI identify patterns and adjust forecasts automatically. If this was helpful, hit like and subscribe. Drop a comment with what finance topic you'd like us to tackle next. Thanks for watching. I'm Brian, and I'll see you in the next one.